Hi, thank you for joining us for our August webinar, going over the Q2 markets and a little insight into what was going to be happening in Q3 with our Director of Investments, Matt Dimitrison. A few housekeeping issues before we get started. If you have it, we're going to reserve all questions for the end of the webinar. So if you have any questions, you can either use the raise your hand function by your name, or there is a question box in the control panel that you can type in questions, and we will handle all questions towards the end. So without further ado, Matt, take it away.
Thank you, Matt. I appreciate it, and thanks everybody for tuning in. The purpose of the call was to kind of walk through what happened in the second quarter. However, it has been an eventful first half of the third quarter already, and so I'll try to do my best as well to include some discussion of what we've seen in the third quarter, particularly really in the last couple of weeks, as we've seen a bit more volatility and some changes in financial markets. To start the discussion, just to kind of review what we saw here in the first quarter, or in the second quarter, the U.S. economy just continues to chug along. It's done better than I think than many had expected, and there hasn't been a lot of surprises. However, and we'll get into details in a little bit, but just the global economy is a little softer. So international markets have not been as strong and have started to see some weakening in conditions while the U.S. has held up. In the markets, equity markets continued to kind of chug along. There was some pros and cons that happened throughout the second quarter, but if you didn't know what happened and went away for 3 months, you look at the returns and say that was a solid result, solid quarter. Fixed income continues to have robust performance. In fact, fixed income markets have done much better than we would have expected this year and have had above average returns both in the second quarter and year to date through the end of June. The dollar had been going through a period of strengthening through the first 3 or 4 months of the year, but sold off in the quarter and softened a little bit. And lastly, oil had quite a volatile quarter. It had just steady declines throughout much of the first quarter and into April, and we saw a lot of volatility, particularly in the months of May and June. We'll talk about that in a second. From an economic perspective, what we're really seeing is, like I said, the economy continues to chug along. We're seeing particularly the consumers really driving the U.S. economy. On average, the consumer accounts for about 68% of the U.S. economy. And the U.S. consumers are doing quite well. We even saw that today with Walmart. They reported their second quarter earnings results, and their same-store sales growth, which is a metric used to take out the noise of new store openings or store closures, but they saw 2.8% same-store sales growth, which is a really strong number for a company such as Walmart that's quite mature in what they're doing. So the consumer continues to spend money and does quite well. And as we look at consumer surveys, we continue to see consumer sentiment remain at elevated levels. The flip side is business investment has kind of softened a bit, and a lot of that is coming from the trade wars and trade negotiations, and businesses are feeling less confident in spending, whether that's in capital expenditures for getting new machines or expanding out their warehouse, as well as inventories. And if you put on the hat of a business owner right now and you don't know what tariffs are going to be and you have to import goods, particularly from China, you probably don't want a lot of inventory. Because you don't know whether the tariffs are going to go higher or go lower. And so you're managing inventory levels fairly tight. And so what we're seeing is soft business investment and business conditions, particularly in the US. Outside of the US, we've really started to see business conditions soften, particularly within manufacturing. So in the US, manufacturing levels have stopped improving, but they've stayed fairly stable and are still kind of in a slightly expanding mode. Although they've kind of in more recent months, we've seen it kind of get to flattish levels. However, internationally, and particularly in Europe, you're starting to see declines in manufacturing activity. And a lot of that is coming out of countries such as Germany, which is a high exporter, particularly a high exporter to China, that we're really starting to see slowdowns in their manufacturing activity, and that's really leading to softer economic growth in those countries. China as well is seeing less exports, and their economy is starting to soften. In fact, they've reported, I think I saw a statistic last week, where their economic growth was the slowest in 27 years. Sounds bad, however, when their economy is still growing at a 6% clip, they're still the envy of most other countries in the world. So we're kind of conscious of that. And what we saw, and we really saw play out throughout most of the second quarter, is central banks are starting to take note of this. They're starting to see softer economic conditions, and they're starting to get to worry about how the impact of the trade disputes, particularly between the US and China, are going to impact the economies going forward. And so we really saw that in more what we call dovish language, or indications that they would start to ease accommodations, whether that being providing more liquidity or lowering interest rates. And that's really the second story that's happened in the economy through the second quarter. We have here a chart that shows US, UK, German, and Japanese bond yields. And from all those charts, you'll say the direction of them was down throughout the quarter, and most significantly down of kind of mid-May through the end of the quarters, when we saw interest rates really start to fall. These are all 10-year bonds, so they're long bonds. They aren't directly impacted by central banks, but they are indirectly, as they are typically viewed as indicators of where market participants think interest rates are going in the future. And so we've really seen this trend throughout the year, that interest rates have come down, particularly as we ended 2018 in a mode of interest rates were only going to increase. To the first quarter was the story of the Fed is pausing. To the second quarter, the rhetoric changed to now the Fed is going to lower rates, and the question is going to be how much. And we saw, as we moved to the third quarter here, we saw on July 31st, the Fed did indeed lower rates. They lowered it by 1/4 percentage point. There was a little bit of chaos and volatility following that, as the market was really hoping Fed Chairman Powell would play his hand and say where interest rates would go at subsequent Fed meetings. And he really called this a mid-cycle adjustment. And that's a fairly ambiguous term, and many now are wondering, well, are there future interest rate cuts or not? But what we have seen happen now in the last 2 weeks is we've seen notable changes in yields across the globe. And you've actually seen in Europe, and for the most part Japan, interest rates are negative across the yield curve, meaning regardless of whether you're buying a bond that's 1 year out or 30 years out, that yield is negative. We've never really seen this before. In 2016 was the first time when we started to see rates go negative, but they were negative really among shorter maturities. Now they're short across the yield curve. And so you're paying, and for example, in Europe, you're paying European central banks 50 or 60 basis points, or a little under 1%, to hold your money for the next 5 or 10 years. And I think that's starting to change individuals' behaviors. If you're paying somebody to hold your money regardless of the maturity, it makes you think twice about whether you really want to be buying those bonds or buying somebody else's bonds. And in my view, I think a lot of that is leading some international investors to the US market, particularly the US Treasury market. And so I think there's greater demand for US Treasuries because there is some level of positive interest rate. There's the risk that the currency adjusts, and that may not work out in a European investor's favor, but they're at least maybe willing to sacrifice that risk to get some yield. And that's pressured interest rates considerably thus far already in the month of August and in the third quarter. And so we saw that. In fact, yesterday was a tough day in the markets. The yield curve inverted across the 2-year treasuries and 10-year treasuries. That's the level of, that's the curve we really focus on for inversion, because shorter maturity bonds, 3-month bonds and 1-year bonds, tend to be a little bit more influenced by what the Fed's going to do. And when you get out to a 2-year bond, that's more impacted by market participants and what they think the economy is going to be doing in the future direction of interest rates. And that inverted very briefly yesterday morning, or yesterday morning. That caused a 3% sell-off in the equity markets. My one comment on that is yield curve inversions have been, at least since the end of World War II, have been a good predictor of future recessions, although they are often a number of months early in that. That being said, yield curves inversions don't in and of themselves cause recessions. There's nothing economically important about a yield curve inversion that says a recession is coming. All a yield curve inversion says is market participants in aggregate see softer economic conditions ahead. They expect the Fed to lower rates as a result of that, and that's often because a recession may be on the horizon. I think there's value in that, and I don't think you want to dismiss that. However, because we're seeing a flood of capital coming from overseas into the US market, and we have central banks buying and selling treasuries, particularly the Fed, the yield curve is a little bit more manipulated than it had been in the past because of those conditions. And so while we don't want to dismiss what we saw in a yield curve inversion, we also want to recognize it may not be as valuable of an indicator as it was in the past, nor may it be in the future. And so that's kind of how we're thinking about it. We don't necessarily read it as a recession is on the horizon. Our ears are clearly tuned up as a result of it, but we recognize there are different conditions today than there have been in past situations when the yield curve has inverted. So, as we look forward to this next, couple months and what we're looking at, clearly central banks across the world have become more dovish. They are looking at additional sources of liquidity, but the market's taken down interest rates in and of themselves. I think the key driver now is going to be currency rates. We saw a little bit of a hiccup there last week when China let their currency, the yuan, run a little bit below where it's typically had an exchange rate at. And I think economies are focused on that because as growth has softened throughout the globe, your export volume is something that you're a little bit more focused on, and a weaker currency helps exports. And so we are going to see a little bit of a currency war is a word that's been thrown around. I think that's maybe too strong, but there clearly will be more and more central banks paying attention to their currencies going forward as well. Let's move on from the economy to the actual markets. So in equities, the second quarter was a pretty good result. The S&P 500 was up 4.3%. That's a solid quarter. A little softer than what we saw in the first quarter, but the first quarter was a very robust market. We wouldn't expect that to continue indefinitely. And so we're very happy with a 4.3% return in the S&P 500. If you look at characteristics of the market, it was a lot of the same things working that we saw in the first quarter and for a good part of 2018 before we saw the fourth quarter sell-off. So growth stocks continued to outperform value. We saw large cap stocks continue to outperform small cap stocks. US stocks continue to do better than international stocks. And within international markets, the developed markets did better than emerging market stocks. These are trends we've seen for some time and continue to play out. What I think if you look at these in aggregate, it's really led to there's a bias more towards good, strong businesses that have some level of defensible traits to it. So we have seen investors that continue to be in equities, although they've moved up into more defensive stances. In fixed income markets, it's also a lot of the same of what's worked in the second quarter was what worked in the first quarter. As the Fed has kind of moved away from raising rates to now pausing and ultimately lowering rates, we've seen long-dated bonds come down significantly. In fact, the 10-year Treasury was around 3.25% at the beginning of the year, and today was nearing 1.5%. So we've seen it being cut in half. Long-term bonds are the most sensitive to changes in interest rates, and so those bonds have done particularly well this year. They did very well in the first quarter and continued to do well in the second quarter and now into the third quarter. From different sectors of bonds, corporate bonds continue to perform quite well. We see the spread, or really the difference in yield between a corporate bond and a treasury bond, continues to narrow, meaning that corporate bonds have outperformed. So long-dated bonds and corporate bonds were really the place to be in the third quarter or second quarter, as those did well. Outside of the US, you're seeing still strong results out of emerging market bonds have performed well. Mortgages are another area to talk about. Mortgages have not kept up with the rest of the bond market this year. A key reason in that is as we've seen long-term rates fall, you're seeing more individuals look at refinancing their mortgages. And as a result of that, some of those bonds where people were excited to get to those are looking at them saying there's going to be a number of prepayments and the bond's going to come due earlier than I thought, and I'm now going to be forced to reinvest in some lower yielding coupons. And so that's led to some other underperformance in mortgage bonds. Outside of equities and fixed income, if we look at commodities, oil had a nice steady trend. You can see from this chart, it had just kind of a nice steady up and to the right trend through March, even into April, and then in May, it started to crack and went from nearly $60 a barrel on West Texas crude down to close to $45 a barrel in early June. A key driver was concerns around trade, was concerns that trade would lead to softer global growth. In addition, Crude production in the U.S., particularly in the Permian Basin, continues to be very strong. And so we've seen a lot of supply come on, and now there's views that there might be some excess supply, and that also drove crude prices down. As we got towards the end of the quarter, if you remember, there started to be a little bit more tension between the U.S. and Iran, particularly in the Straits of Hormuz, and that drove up oil prices. So we ended the quarter about where we started, but it was a wild ride throughout the quarter. Gold is actually one commodity that has really started to catch a lot of interest. Gold had a very strong second quarter, up 7%. That strength continued into July and has now continued into August and as well. Gold is really being viewed as a safe haven here, as some investors have gotten a little skittish on market conditions. Silver, however, it hasn't been the same story, and that was actually flat for most of the year. The other area to talk about within commodity is agriculture. So corn has been an interesting one, where as we were getting early on into the second quarter, it was a wet beginning of the spring. A lot of fields were not able to be planted on time, and so you saw corn prices go higher, as many had thought that would mean lower corn supply. That's kind of held, and now of late you've seen corn prices roll over actually quite significantly. Two drivers of that: first was on the trade side. China came out and said they were not going to buy U.S. crops, or at least as many U.S. crops as they had indicated back in June. In addition to that, it does sound like more farmers' fields were planted than initially thought. So we've actually seen corn peak at $4.50 a bushel early mid part of the second quarter, and now today is trading around $3.60 a bushel. In currencies, the dollar, as I mentioned earlier, weakened throughout the quarter. In fact, it ended the quarter probably at near a trough at about 96 on the dollar index. Since then, as we look into the third quarter here, the dollar's been on a tear, and it's up a little over 2% as we look thus far this quarter. It doesn't sound like a lot, but currencies tend not to have that much volatility and that much movement. So 2% move in the currency is at least something to take note of. So that kind of concludes kind of a broad look across the economy and at the markets. As we look ahead, I think one statement that we put in our commentary was the secret to investment success isn't to know the future, but rather to be prepared for any contingency. And that's something we're living by and thinking about actively on a day-to-day basis here at Telemis. A key driver of a lot of the volatility and the shifts that we've seen this year has ultimately had an underpinning around trade. The Fed has changed its position on interest rates largely because of what is going on trade and the potential economic ramifications of that. And we don't know how it's going to pan out. In fact, nobody knows how it's going to pan out. This is a game theory situation where the US and China are looking at each other and figuring out who's going to blink first. And what we don't want to do is position portfolios for one outcome or the other. And so as we look at this, we believe it's important to maintain asset allocations, maintain them near or around their targets. However, within each of the asset classes, we've started to move towards a bit more of a defensive posture. If this doesn't play out as well, we are seeing softer economic conditions outside of the US. Not sure if that translates to the US or not. I think it's going to depend on the outcome of the trade negotiations and how long that takes to come to a resolution. And so we think being a little bit more defensively postured, especially after we've had such strong gains in the markets thus far in 2019, is a good way to position portfolios. The other thing to comment on that is on volatility. We've clearly seen a lot more volatility in the markets just in the last 15 days or so. And it's never fun to go through a period of volatility. Volatility is what creates long-term opportunities in the market and in investing, but it's never fun to go through it. The other thing to consider is we've also gone through this record period of extremely low volatility in markets for the last 3 years. And we, and myself in particular, have gotten conditioned to just expecting low volatility. And then you see periods like last Monday or like yesterday in the market, and you see spikes of volatility, and it gets a little bit of concerning. 3% move is always concerning in the market, but it's also to be important behaviorally that we've really been conditioned to times where there's just not much going on in the markets. And now we're going to, I think going forward, we're going to see more volatility, and we have to recognize that that will occur. But with that creates long-term opportunities as well. So that kind of concludes our comments on the second quarter, and I will turn it back over to Matt Rand, and if there's any questions out there.
Thank you, Matt. Don't see any questions. So just want to say thank you again. Great job. And we will have a video recording of this webinar that we will send out to all the attendees. So thank you again for joining, and join us next month for a webinar on philanthropy.